Manuel, thank you for that introduction. I'm delighted to have an experienced and seasoned panel of impact investors with demonstrable track records in investing in impact and SDGs. I think each of them has made important steps in their portfolios, which they will outline. The crux of the matter for this panel really is ambition and scale. As I think you will have heard, and many of you will be aware, the scale of the SDG funding gap has increased as a result of the pandemic, from $2.5 trillion to $4.2 trillion, as estimated, I believe, by the OECD. Private capital will obviously be very, very important to this. So that's a call to action really for more institutional capital, more institutional ambition in investing against the SDGs, and of course along the value chain of institutional investment between asset owners, asset managers and others who provide services to them. And I think this is an opportunity to reflect on the scale of that challenge as well, because scaling up is not necessarily simple and straightforward, as I think we will be discussing over the next hour or so. In terms of aligning portfolios, this requires significant thought and deployment of capital across asset classes, which brings with it significant and distinct challenges between public and private markets. For instance, to give one example, it requires vigilance in terms of oversight, in terms of avoiding SDG washing or impact washing, terms which we have become familiar with. I'm going to ask each of the panelists, first of all, to give an overview, so just in terms of the session structure. So what I'd like them to do each in turn is to really outline the activities that they have with relation to the SDGs and impact in terms of the quantum, euros and dollars, and in terms of the relating to that's to their entire portfolio, and what really their journey has been, and what they see as the important aspects of alignment and scaling up from their initial experiences, perhaps a few years ago, in impact, and applying it across the portfolio. So I'm going to stick to the order that the speakers appear in the program. So Marte at Aviva Investors, that means you're first in line. So would you like to give us your overview to start off with?
Yes, hi, thank you so much, Liam, and hi everyone. It's a delight to be with you today. I'm dialing in here from London and looking out just on a school here, and it's exciting to see all the school children back at school. So, you know, things are starting to return to normal. So our SDG alignment has been a journey for multiple decades, to be honest. And I think as a Norwegian speaking here today, when I grew up, just a very short story here, when I grew up, we had a prime minister called Gro Harlem Brundtland. And she was not only the first Norwegian female prime minister, she was also one of the women and leaders behind defining sustainable development back in the day in 1987, when I was 1 year old and could barely just eat. She was trying to define sustainable development for all of us, and her definition was that we need to create an economy and investments that can make sure we don't put simply, use up the planet for the people that come after us. So fast forward 34 years, where are we today? I think the sad story is that we're very far away from delivering the SDGs. And I think part of that is because, like us, a lot of investors, a lot of companies have not done what they should have done. And so I'll just start there by saying, the issues are grave. The problems we're trying to overcome are huge, and we're still very far away from achieving it. So let's use 2021 and some of the lessons we've learned from COVID, where we saw how much the world can act in a very short period of time, to really try and get some urgency behind this. So our journey, I would like to flag three key things that stood out to me as important as we've tried to get our hands around how do we take 350 or so billion of assets under management and try and do our best to align those to the SDGs. And that's number one, avoiding a siloed approach. Number two, taking action now and not waiting for perfection. And number three, working with stakeholders. So I'll try and give a couple of examples for each of them, and then hopefully we can get more into some of the details in the discussion. So first of all, holistic action and not getting into a silo. So I think Ava, just before us, used one of the stats I was going to use about how, human rights is so closely linked to 90% of the SDGs. Another example is from the Drawdown Project, which talks about, if we want to tackle climate change, one of the biggest levers is actually to empower women. And for me, this is one of the main lessons that we've learned when we try to tackle the SDGs. Yes, climate change is important and tackling biodiversity is important, but actually it's about how we look at all these issues and not sort of go hunting for one or the other, but really look at how is all of our capital impacting, having either a positive or a negative impact across all of the SDGs. And I think it was Einstein who said, let's try and make things simple, but not simpler. And I think that's really essential here. So, the way we've gone about it is, yes, we've set some targets, some bold targets. We're going to be a net zero company by 2040, including all of our investments. Huge ambition. We don't know exactly how we're going to get there. We have some plans in place in terms of putting targets for carbon reduction by 2025 and 2030. We've got some ideas around some of the funds we're going to launch, how we're going to allocate capital. But what we've also done is try and really think about what are we doing around human rights, what are we doing around biodiversity, etc. So have a holistic approach. Second point for me is that taking action now and using the whole toolbox. So let's not wait for perfection. One of my favorite quotes is, it's better to be roughly right now than perfectly right when it's too late. And I think when it comes to the SDGs, it's like we're jumping out of a plane and we might be pulling the parachute a bit too late when we're 1 meter from the ground. And we need to therefore start taking action now. So as I mentioned, we've set some really bold targets across all of our assets, even if we know we can't perfectly measure all of them now, but we're going to have to try and figure it out as we go. And finally, and I leave it at that then, Liam, is around working with stakeholders. So it's important as a big asset manager and investor that we don't do this on our own in a silo. It's important we talk to our customers. So we've been launching some exciting tools, opening up and really showcasing what we do so that every single pension holder can actually see where their money is going and be part of our journey. And we've also worked a lot with civil society organizations to establish new institutions that can drive change, like the World Benchmarking Alliance. And I hope I can touch a bit more on those in the discussion, but let's work together, multitude of stakeholders to really deliver on the SDGs.
Thank you very much for that introduction, Marte. So I'd like to go now to Jos Gijsbers at ASR Nederland. And like Marte, Jos speaks both, well, he can speak both from the asset management and the asset owner side, as both ASR and Aviva, of course, have a background and a business footprint in insurance and insurance asset management. So Jos, over to you for your introduction.
Yes, thank you, Liam, and I'm also very honored to be in this panel. And I also want to thank Phenix for organizing this event for many years now, and I've been at all of them, and I'm still very excited to be here and to see how the community is growing, and also getting more and more attracted by institutional investors, because that's where the money flows and where we can have the biggest impact. But also thanks to all the smaller initiatives that were there in the past that created this ecosystem. And well, at ASR, we are indeed a Dutch insurance company, only 70 billion euro of assets under management. So it's still, I think, a large amount of money. And we celebrated last year, not really, of course, our 300-year anniversary. And that makes us also humble, because we've got a rich history, but in the strategy of our company, we said we need to be useful in the future in many ways for our stakeholders, but also in the way that we manage our money. And well, we didn't realize it, but impact investing was already part of that strategy, of that approach. In fact, we still own a Dutch sovereign bond issued early in the 19th century to rebuild the Netherlands after the French occupation, which was not the best times of all, but we needed to rebuild the Netherlands. And so it was a perpetual, and also ASR was one of the investors who financed that recovery. And well, still, Netherlands is a great country, also great weather today, although I can't enjoy it that much working from home. When I look back at what our journey was, well, as I said, we took a very important step in 2007, making a strong sustainable investment policy, including impact investing as one of the pillars. And also, the next important step was that we decided to put also a budget on impact investing for all investment teams. So it's not just a nice investment to greenwash our activities. No, all investment teams have their budgets, have their definitions, and also contribute to that budget, which was set at 1.2 billion for 2021. But in fact, our teams got a little bit lost in their activities. So we already have 1.7 billion of impact investments on our balance sheet at the end of 2020. So involving everyone is a very big accelerator, and also helping them. And as Marte said, we don't have the perfect data, but we think that avoiding adverse impacts is key, and also contributing to our values is then the next step. And at ASR has defined that we will target a number of activities that fit best to our insurance company and asset management, which is financial inclusion, vitality, and of course climate change. And that also helps us to see where we have our impact, and also to look at opportunities, investment opportunities, which might be a little bit outside our standard universe. And so we keep on developing the policy, keep on taking steps, and later this year we will have new impact targets.
Great, thank you very much. And we'll come back to the subject of targets in a minute, I think. So next in line is Terhi Halme of APG. Over to you, Terhi.
Thank you, Liam, and thank you also to be able to be part of the panel. It's a great pleasure to talk to you all about these very important and exciting subjects. At APG, we manage funds of our pension fund clients with the total assets exceeding 500 billion euros. And for us, investments in companies that we consider to provide solutions to some of the externalities highlighted in the UN Sustainable Development Goals are a very important part of our portfolio management process. We do not have a separate SDG fund, or what we call Sustainable Development Investments Fund, but we make sure that this is an integral part of all of our entire portfolio, irrespective whether these are private or public asset classes. So for us, our investments in these sustainable development investments that we believe to have this positive contribution to the SDGs have to also meet our financial risk return requirements that we have for all of our investments. We have been including these into our investment processes for already quite some years, I think about 5 years by now, as also our clients have challenged us to increase our investments into these SDIs further. For example, one of our largest clients already in its previous responsible investment policy at the time in 2015 challenged us to double our investments in what we call SDIs. And at the end of 2014, about 14% of their AUM was invested in these SDIs. And in January of last year, they gave us a new challenge to increase this percentage further to 20% of the AUM for 2025. And a lot of our work, apart from, of course, integrating this into the investment process, has also defining and establishing what would be an appropriate framework and where to find the data to do this. So we took the SDGs as our starting point, all the 17 goals, as well as all the underlying sub-goals. And together in collaboration with other asset owners, we have been making an investor interpretation of this. And last year with BGGM, British Columbian Investments, and Australian Super, we were in this great position to be able to launch what we call a Sustainable Development Investment Asset Owner Platform. And yes, for us, the journey started regarding the SDGs in particular in 2015. And it has been a very exciting journey, and certainly will continue for several years to go. And I'm sure later in the panel, we'll talk more about the platform and all the excitement around targets, data, etc. Thank you.
Thank you very much, Terhi. So last not least, across the water to New York for Andrew Siwo, over to you.
Thanks, Liam. I'm Andrew Siwo, and I serve as the Director of Sustainable Investments and Climate Solutions at the New York State Common Retirement Fund. I am the portfolio manager for a tapestry of investments that are closely aligned to the UN Sustainable Development Goals. Our program consists of 9 sub-themes that are equally split into 3 categories, which are resources and environment, economic development, and human rights and social inclusion. Our expectations of managers that we find to be a fit for the portfolio is 1, to be accretive to the portfolio, and 2, to advance 1 or more of those 9 SDGs. We enjoy a funded ratio of at or around 90% historically that we're pretty proud of. And that's partly due to the remarkable leadership of our Chief Investment Officer, Anastasia Titterchuk, and then also the New York State Comptroller, Thomas DiNapoli, who is the sole trustee of the fund. One of my key deliverables is executing the Climate Action Plan, which was released in June of 2019. And this is a comprehensive document that serves as a guideline for protecting the assets in the portfolio. We do see that climate risk is an intractable risk, and our approach consists of 3 things. First is identification of an assessment, engagement and advocacy, and also investment and divestment. And so we have several tools to execute the Climate Action Plan, as we are constitutionally obligated to providing benefits to more than 1 million members of the plan. And we are pretty excited about the future. The goal of this portfolio is 20 billion. And last year when I began, the portfolio was roughly at 8.6 billion. And we are currently at 11.6 billion. So over the course of 13, 14 months, we've put over 3 billion into the ground. And we're excited about the future.
Great, thank you very much, Andrew. That's very exciting indeed. A quick message to the audience. So the Q&A is open. You can see that on your event console. And I see we're getting a question coming through. So just a reminder, we will be setting aside time towards the end to come to those. So please do continue to send your questions through. So we can't see you. We're not in the Peace Palace in The Hague, but we know you're there when you send the questions in. And I think it's really important to get that interactivity. So the first question, the first discussion point that I wanted to go back to was around targets and hard targets. And I know that you have speakers, you have different perspectives from your organizations, and you may or may not be involved with setting those targets. And Terhi, can I go back to you first, because you said the most about hard targets. You don't set them. I think your asset owners will be setting those, and you are obviously separate from the underlying pension funds, a bit like Andrew in the New York State Common Funds, with different underlying clients. What is your experience, and what perhaps are the pros and cons of setting hard and measurable targets?
Yeah, that's a really good question. Indeed, you're quite right. It is our pension fund clients that they give us a challenge, and they have set us a target. And it has actually worked quite well from also our perspective, because I think that this provides us with a really clear path how to steer capital towards the businesses that we believe that have this positive contribution to the SDGs. So there is this clarity, and there is the incentive to take action with the portfolio management and the investment teams. What has been perhaps then one of the bigger challenges over the past years has been to find the right data and the right amount of data to be actually in a very operational way to fulfill the target in a meaningful way, and also make sure that you stay close to the integrity of the SDGs themselves. And that has resulted in us, for instance, forming collaborations with other asset owners, and also developing initially the frameworks ourselves. So it was back in 2016, after we had, of course, gone through with a great level of detail the SDGs and the goals, that together with PGGM, we defined what we call a taxonomy. So that is our investor interpretation of the 17 goals and the 100 plus sub-goals underlying them. And then we looked for a technology partner, in our case, a company called Entis, to help us making the taxonomy operational and looking for the data behind it. And then the collaborations with the other asset owners deepen further. And as very briefly mentioned in the introduction, that last year we were able then to launch the platform. And that has been our way of coming up with a global interpretation of the SDGs, and then giving meaning to it through the collection of data.
Excuse me. I think you're raising the issue of standardization there, which is a very interesting one, and no doubt we'll come back to. Jos, you also mentioned targets a little bit. What's your experience been, and perhaps what's your advice to others around the advisability of holding yourself to account to implement these things?
Yeah, that's exactly why we defined a target of the total sum of impact investments without knowing which SDGs and which specific indicators there in the underlying companies would have a positive impact. But that's exactly also what Marte earlier said. We are not waiting for that perfect taxonomy. We started impact investing. In fact, we did that already before anyone knew what impact investing was. So having that exposure already fits also in our philosophy that impact investments or broader sustainable investments will have a positive impact also for our portfolio, as well for the stability, as probably also on avoiding risk or financial returns, because we think this can be the winners of the future. Well, like the example on climate change, that this is sure something that will happen, and we say also as investors, the trend is your friend, so we follow that trend and also positioned ourselves with these budgets, and definitely after that, with the SDGs, that was a nice framework to align a little bit our targets, but we are still also developing these metrics, and we have also done a pilot recently using artificial intelligence to see what our impact is on the SDGs. And it confirmed what we already thought, and this will also help us to take a little bit more that specific indicators that we are looking for maybe with the next investments.
Great, thank you very much. Perhaps Marte next.
Yeah, perhaps a slightly different angle on targets, because I think we talked a bit now about targets for our assets and where you invest or where you don't invest, which I think is really important when you set targets. But two other ways also of setting targets, and I think Andrew was talking about this in terms of we have so many tools in our toolbox as investors, and one of them is engagement. So if you own an asset, you can actually drive engagement and really push a company to change. But sometimes I think investors maybe have been doing that without being very clear to their clients and the rest of the world with the targets they've got in place for that engagement. So it's been happening a bit behind closed doors and you're not really sure what's actually happened. And I think that's where, well, one of the things we're trying to do is to be very clear in our communication around our engagement targets. So this year we launched our climate engagement escalation program, where we have said for the, we picked 30 companies, which according to our estimates have about 30% of global emissions. So, big companies, big emitters, and we will be engaging with them in a time-framed manner. And if they don't change, we will divest. And so I think what we're going to see in this space a lot more is investors partly setting targets about their assets, but also being much more clear about the targets they will be setting companies when we're engaging with them. And ultimately, there has to be a carrot, but there also has to be a stick at the end of that engagement as well. And I think that's one way of also setting target. And the final thing I'll say is also on putting some targets for the people involved. There's nothing like embedding some of these targets into the pay of the management of the company. So, one of the things that we think is important, both as a firm as well as the firms we invest in, is to see this embedded into how they evaluate management. And so hopefully we will see a lot more of CEOs being evaluated on their climate or diversity performance, as well as their financial performance.
Right, yeah, and starting to see that coming through. So a question then, what if targets are missed? Because you need to be transparent about that, don't you? And just one little aside, there's lots of it's good and it's great for organizations to communicate about what they're doing in SDGs. And let's be honest, that makes good PR. But it's not such good PR if the message is that the target hasn't been met. And I think some transparency is important. And as we did report in the last week or 10 days or so, there's one Finnish pension insurance company that was transparent about the fact that it hadn't met. I think in this case it was a Paris-aligned investment target that it was talking about in its communication. That's very important as well, isn't it?
Absolutely. I mean, maybe Andrew wants to add some things here, but I think absolutely, Liam, we need to be transparent when we don't meet it. So ultimately, one of the things that I hope will change as well in the industry is we move away from annual reporting only to more regular communications with our clients. So back to the kind of technology platform that I was talking about earlier, what I love maybe not just as a millennial, because I showed it to my mum and dad and they love it too. But, this platform allows me to see immediately which companies I hold in my portfolio, what engagement and voting my fund manager has done on my behalf, and hopefully over time, the targets they've set and how they're meeting it. And, imagine if we could sort of walk into a shop and see, oh, I'm invested in this company. Have we managed to drive change with this firm or not? So a little bit more agility and a bit more technology might allow us to be much more transparent as an investor community. I think we've been probably used to doing one report a year and that's it, and then we go back into our silo and do our thinking.
Thanks very much, Marte. And Andrew, did you have any further reflections on the targets question? And then perhaps I can bring in my next question, which is around others in the value chain, in particular asset managers, and what your advice would be to them in terms of what they need to do and do better. We've had some of the speakers have obviously already touched on that.
Sure, I'll quickly address both. So first, there are 17 SDGs. These were set in 2015 and they have a 15-year duration. So for alternatives, a typical closed-end fund duration is 10 years, and then close to 15 years after 2 one-year extensions, which is a more prominent phenomenon today. Now, the SDGs have been helpful in exploring what may have been perceived as secular trends that now persist and have inherent investment risks and opportunities, such as climate change, inequality, and population growth. And unfortunately, there are no vaccines for each of those. Relative to the scarcity of resources in a way that is digestible to investors. The SDGs have certainly increased awareness, though with just 9 years remaining, there's growing skepticism of whether these interlinked global goals designed to be, quote unquote, a blueprint to achieve a better and more sustainable future for all will actually materialize. An observable unintended consequence, which was actually predictable, is SDG washing, which I know we'll get into. Though I would say that there are competing interests where governments have to make practical decisions that often are less utopic. And the challenge of the appropriate accountability measures that are necessary for a 15-year duration goal is an area of concern. And so that's something that I think many are noticing. Now, your second question regarding advice, there is no ESG police, there is no impact police, and there is no SDG police. A publicly traded company, for example, selling cell phones, qualifying for advancing an SDG may make some people grimace. Yet there's no regulation of who can use the SDGs and how they are used. I'd say, though, what is useful in this case is analyzing the targets that are beneath these SDGs. So there are, I believe, 169 of them, to better understand the case that the manager is seeking to make, which will be harder when there is a feeble case being made. So for us, this is not a space where we need particular assistance, so to speak, and it's more of a method to examine the strength of a manager's investment thesis.
So there's certainly some interesting and colourful claims made when you take time to browse around some of the impact reports that corporates are doing. It's good they're doing them, but obviously that requires additional scrutiny. Terhi,
if I could just add one thing, I think a lot of managers got really excited. You see this really beautiful, colorful pin. How can someone dislike this colorful pin here? And so you see this slapped on every investment presentation, and so it's hard to resist.
Indeed. Terhi, did you have any reflections on that, on your communication and what you need to get really from others in the value chain? And I know that another question that we'll go on to is sort of the costs and the transparency around all of this.
Yeah, indeed. I definitely agree what Andrew was also saying, and Liam, what you have also previously highlighted. It really is about making an analysis of the SDGs and the sub-goals and understanding what is the spirit and the intention of these goals, and how can we translate this into our portfolios in a meaningful way that we still stay true to the underlying goals, because that's ultimately highlights the externalities that we would like to find solutions to. And it is so important then to be able to provide a transparent framework that what was the interpretation of these and which process did you follow? And then perhaps next to that transparent framework and understanding and creating really an auditable framework around it is also the importance of having then good, robust internal governance processes around the portfolio management processes, and also good governance processes of how these kind of definitions and frameworks and interpretations have been made. And then perhaps as a final point, what I think that is also important, and that's certainly what we also use, is the recognition that what is the role of these kind of factors into the investment process. And in our case, how we consider whether we call them SDGs, sustainability, ESG factors, we talk often about a square, that these factors are at an equal footing with also how we are looking at risk and return and cost side of our investments. So this is part and parcel of our investment proposition. And then there's a good transparent method and a good governance around it.
And Marte, perhaps very quickly, Marte, as an asset manager, as a publicly traded company yourselves, Aviva as part of all of that, what's your perspective on the challenge of sitting where you do within the investment management side?
I think to both Andrew and Terhi's points about being transparent about what you have done, because I think in this world, the worst we can do is to try and overjig what we're trying to do. So from our perspective, for example, we have some strategies that are targeting a transition, and we're not selling those as, a perfect only green strategy. We're saying this is a transition approach where we're choosing to invest some of the capital into more green companies, but some we're trying to take out the worst, but then try and invest in, let's say, the ones that we call have a transition momentum, companies that are showing a willingness, setting targets, showing that they're interested in moving forward. But you need to be very open and honest about what you are doing and what you're not doing, and not trying to make something sound fancy or colorful in any way. But because there is no impact police, all you can do is have your own conviction in what you believe is important, what the impact targets that you're trying to accomplish, show people how you've delivered your analysis, and then be transparent about it at the end of the day. I would also say one more thing back to the kind of stakeholder process. I think one of the biggest challenges we get is, yes, we can sit in our ivory tower as a fund manager or an asset manager and decide how we believe these companies fit into our portfolio. But what about the stakeholders surrounding these companies, or a windmill park? What about the local population? What about their workers? And increasingly what we're trying to do is making sure that we actually find smart ways of listening to other voices. And that's why I come back to my third point from my intro, which is stakeholder relationships. We think it's important to build alliances so that the workers and the companies and government and investors and the NGOs around this ecosystem of an economy actually work together to try and drive change. Because if one investor tries to do something over here, but the union over here are not getting heard, then we may not be able to drive the right change. So perhaps in the next coming years, my hope is that we have better stakeholder relationships, more sort of joint engagements with companies, rather than individual letters being sent here and there and individual activities happening. So that will probably be my view. Transparency, being honest and clear about your own conviction, but then also thinking about how we listen to other stakeholders that may not have a voice in this debate.
Thank you very much, Marte. I think cost is also another very important aspect, and all of this implies resources. It implies time and attention. And that obviously implies cost. In many institutional markets in the UK, in the Netherlands, I know cost is a very, very important aspect. And you, as pension funds, I'm sort of thinking of APG here, obviously managing pension money. There has been quite an interesting journey in the cost that you are now required to display and communicate to the public. Terhi, perhaps, do we need an honest dialogue and honest communication about all the resources that this implies?
Yes, of course. That's a very important factor. And I think that in our case, like one of the reasons, of course, why we wanted to collaborate with others was, partly was from the content perspective, of course, also to get a global understanding and interpretation, but also it is a way to share resources. And also then in terms of when looking for the data, we made also the conscious decision to collaborate with a technology provider. So they use different kind of AI-related toolings techniques. And one is to give more context to the data that we are able to find, but it also brings, of course, great efficiencies in the data collection itself. So using different kind of AI tooling and collaborating with other asset owners has been our way of also addressing the question around resources.
Jos, can I bring you in here? Perhaps what are the implications for your team? Human resources, of course, and and of course other resources, as we're hearing.
Yeah, well, when I look at our ESG team, well, their work has exploded over the last 10 or 15 years. But we also believe it's very important. So costs go up, that's fair to say, and you also need additional data. But at the same time, we do think that it adds value to the investment process. And therefore, it is also in our strategy and our long-term view important to keep on developing these kind of AI techniques or data mining or other sources that can be important to us to get a better picture. In the past, investors were only looking at financial and economic data, but these non-financial data also give very important information about the company, and especially also we are looking at future indicators. So like an energy transition score, which looks how a company is positioning itself for the next 3 to 5 years on climate change, which can be a very important indicator of how this company will also do in financial way. And we also see a very interesting development that a lot of these data providers are also acquired now by the traditional data providers like the Moody's or S&P. So it becomes part of their integrated business model, which also makes sure that costs go down. But therefore, it's very important to have a better understanding of what's required, what indicators, what metrics are important, and get some standardization in our international investment world.
Very good. That brings us on to another important point. Andrew, but before we go on to that point around standardization, Andrew, you're a public entity as well, so I imagine that the costs and resources are an important factor.
Yes, indeed they are. And our obligation is simply to protect the assets that we shepherd on behalf of pensioners. If we take a step back, there is a realization that not every SDG is investable at scale. And there is not investment value in forcing ideas or investments that are not a fit or accretive to our portfolio. So the first question that we have when evaluating managers is whether the investment strategy can produce extraordinary returns relative to the expectations of that asset class. And if there's duality of also advancing one of the 9 themes that we've set, then we believe that that is a positive item as well. And the resource constraint that you identify is real. And as a result of that, our sourcing, assessing, and identifying our opportunity set is done in conjunction with those asset class teams. So we have a one team, one dream model where we don't bifurcate these investments. And they are all benchmarked accordingly. One great highlight is that we funded 2 core fixed income managers last year, benchmarked to the Barclays Agg and their publicly traded very strong impact thesis. And they outperformed the Bloomberg Barclays Agg by north of 300 basis points on a net basis last year. So they are very competitive. And those are the types of opportunities that we're looking for and we're finding as well.
Great. Thanks very much. So the next point I wanted to touch on is really standardization. We've touched on it already, but it really is important across the value chain. And we've been hearing in other sessions in this conference around the standard setting and reporting and how alignment is needed. Which of you would like to perhaps outline the challenge that we have here, and the challenge and the opportunity, perhaps? So I could turn to Marte to reflect on that.
Yeah, maybe I'll cover some of my views. I know that Terhi will have some thoughts here as well. So from my perspective, we do need some standardization. So I think, we are pleased both in the impact space and the climate space, etc., that some of these global bodies, I think I read somewhere that there's 60 plus or so different standardization projects as well. So if all the standardization projects could come together, I think that would help as well. That yes, that will be beneficial. But in my view, and this comes back to my point about not letting perfection be the enemy of the good, I think there is already a lot of data out there. There's a lot of ability for us to do good due diligence on companies if you have the right resource and if you invest in it and if you have the expertise. And so in our opinion, whilst we are supporting standardization, we're supporting governments taking action and introducing minimum standards, like in the area of human rights, where we're seeing that years of engagement and years of voluntary initiatives hasn't actually lifted the minimum standards. You need governments to come into play. However, that doesn't the waiting for standards and waiting for the perfection doesn't mean we can wash our hands from our responsibility to do proper due diligence. And so a good example is some of the companies recently where there have been some scandals in the press, both here in the UK and globally, companies coming out where it's sort of the ESG score might have looked good, but actually underneath it, there was a lot of maybe dodgy behavior or things that wasn't as good. It just shows the importance for us, for fund managers, to have a team, to have experts in this area and to spend time understanding where they're putting their money. I think anyone can take it and buy a score and chuck a score on a portfolio and try and optimize their portfolio towards it. But if you do that, there is a risk that there will be those hidden problems and that you haven't actually done a good enough due diligence. And so in my view, one of the big things that asset managers are going to come under scrutiny for is have you done your due diligence both on human rights and on climate change, and can you evidence how you've done that and that you've looked under the bonnet of some of these scoring methodologies to really try and understand where you're putting your capital. And we understand that not everyone has that scale and can afford to do that, but in our view, it's very important. So one example is hiring the right people with the right expertise and realizing that you can't become a climate expert after just one course on climate, or a social expert. Some of these things are strong expertise where the world has that expertise, but they don't exist in the financial services sector. So how can we hire more diverse talent? How can we hire people that have a background in social development or in climate or in biodiversity, so that they can help us better understand where our investments are going?
Yeah, and I guess that part of that comes back to the initiatives that Terhi has outlined that they're doing with PGGM and others in order to share that burden. But perhaps to go back to you, Terhi, did you have views on perhaps what's needed, perhaps just to sort of encapsulate what what your wish list would be? At APG, you do have a significant amount of clout and I know you do express your views on these matters. I think what Marta's referring to is sometimes called the alphabet soup of different initiatives and so on.
Oh, of course, we recognize it as well. That also when it comes to the SDGs, that there is every day a new initiative that has something to do with the SDGs. So I fully agree on the point. And also to say that indeed there is always a due diligence that is required into the investments that is not going away. And I think that in terms of, like, for instance, with the asset owner platform, that something that we mentioned or has been mentioned in this panel already a few times, to be able to provide a very transparent process into the matrix, how is it put together? What is it? What are the sources to it? I think that will also greatly help further standardization into kind of the way of investing into the SDGs, as well as what I mentioned previously, to have global partnerships with other like-minded parties. And that is also one way of contributing. That indeed certainly wouldn't wait for the perfection to come, but that would also call investors to take the lead on this as well.
Excellent. Jos, did you have some views on the challenge?
Yeah, but I like challenges because that keeps you sharp, and that makes sure that you can also maybe when you manage to complete it, that you take a step forward. And I think it's possible to take these steps. It will take time. You need partners there. But I've been involved in the partnership for carbon accounting for financials, which started in Holland. And last year, that startup was a global standard. And that helps us to measure carbon emissions of our investment portfolio, and also to be Paris aligned and set targets for 2030, where we already say we are going to reduce carbon emissions by 50%. So we can do it. We can, working together, we can do it. We can set these standards, we can develop it. But as investor in all companies around the world, you need also data for all these companies and to report on them. So yes, we're at the last point in the chain, and we need all this data, but we see that we can do it and we can take these steps, and also make sure that when there are dilemmas, that we can also tackle them together with stakeholders and also with a dialogue, and make sure that we include also the poor countries, we include also the difficult sectors, and that's also very important to also look at the most vulnerable sectors and countries.
Great. Perhaps can I go over to Andrew? A question that occurs to me is what's the understanding and recognition in the US of SDGs? And I'm thinking also in the corporate sector. You're wearing the SDG pin. Part of this, if we're going to get robust data, that means that people right down the value chain, and we're talking about into the S&P 500, into the small and mid-cap arena, that those boards are really well versed and they really know what this means. Can you give us a sort of view, because perhaps we don't really get all of the dynamics of what's going on in the United States. Are you seeing positive movements?
Sure. So if there was a direct link between ESG data and performance, I think we would be all in Tahiti right now, eating bonbons and doing Pilates. And so it's a messy space. And I think what we're talking about, all of us here, is last September, there were several standard setters for voluntary ESG reporting. And I hope I remember all of them. There was the GRI, there's the CDSB, there was SASB, there was the IRC, and also the CDP. We all issued a joint statement of intent and announcing a commitment to work together to create this a comprehensive corporate reporting system. So ESG frameworks and standards are largely voluntary. They're also non-binding, they're unauditable, they're voluntary. And so very rarely would an investor make a decision on something that is voluntary, unaudited, non-binding, and unauditable. So market participants look to these guidance and disclosures, but the reality is just the proliferation of these numerous ESG disclosure standards in some of the recent years have amplified calls for this common ESG reporting framework that we're all talking about here. And there's been rising frustration among corporations and investment groups over the plethora of competing systems in measuring sustainability. Now, without a single standard, I know it's difficult for investors to compare one company's ESG disclosure to another, and for companies to really decipher how to report ESG information. But what was stated before, this should be hard. And it would be surprising to me to be, if you look at a publicly traded company's website of the analysts that cover them, let's just say 12 or 14, 3 of them are going to say buy, 3 of them will say hold, 3 of them will say sell with the exact same information at hand. So for everyone buying a stock, there's someone selling a stock. And so I'm not quite sure if we're looking for convergence, if that's going to be there. The brilliant managers that I've seen don't do a lot of whining and complaining about this, because we've been saying this for 10 years. They use ESG for certain purposes, but it is not the basis where they're forming their investment decisions. And I think we should kind of understand that. But this waiting for a silver bullet or a magic wand, that is I think we're going to be waiting for a long time. And then finally, even if we look at reporting, even in this in the world of accounting standards, there are companies that have to do restatements in terms of revenue recognition. Is it a accrual basis? Is it a cash basis? It's even messy in something that's been developed for 100 years. So even if they can't, if all the companies are reporting earnings, that's a signal also to just this imperfect space that we're in.
Great, thank you very much. I'm getting a message that we've got about 3 minutes left, I think. So that means that the time has slipped through our fingers. And if I'd been slightly more on the ball, I would have brought in the questions. So we'll have to wait for those another time. So I'll just do a quick recap. I really liked Andrew's encapsulation when he says there's no SDG police. This requires qualitative judgment. I think this is coming through very much in your views and your assessments. As he also said, just said a couple of minutes ago, there's no silver bullet. So greater data and transparency does not necessarily mean that you have more to rely on. And I think Terhi also said this a second or two ago. The due diligence will always need to be there. However, having said that, it will be very interesting to see. I think 3 things really to look at in the next decade.
Sorry, Liam, may I ask? Sorry to interrupt you. I'm really apologise, but could you keep it very brief, please? Those 3 points.
Okay. It's going to be right. Okay, it's going to be tech. It's going to be the initiatives that investors are involved with, and it's really going to be the standardization and how these standard setting bodies come together and what that means. So that's 3 important things to look at. And I do apologize that we've overrun, but I hope it's been good value to everyone.
It certainly has, and sorry for playing the bad guy, Liam, but I've got the great excuse that that's part of my job. So thank you, Liam, for moderating a great panel. This was very insightful, and conscious of time, we got to hurry on to the final closing keynote. Thank you. Cheers.